Hi, today we will be discussing inventories with a specific focus on the effects of inventory methods and misstatements. Our objective today will be to discuss the effects of inventory and methods and misstatements of inventory on income determination and income taxes. We have discussed 4 inventory methods during this chapter. Each of those 4 methods of inventory pricing is considered to be acceptable for use in publishing financial statements for corporations. A business must choose one method over the others after considering trends of prices, the effects on financial statements of the method, and income taxes and management decisions. Let's look at some of the factors affecting decisions relating to inventory. During periods of inflation or rising prices, FIFO provides a higher income before taxes than does LIFO. The reason for this is that the cost of goods sold is lowest under the FIFO method because the cost of goods sold is based on the oldest priced items. The first items in will be the first items sold. So during a period of inflation, those last items that were purchased are now costed into the inventory, not into the cost of goods sold. Under the average cost method, this produces income before taxes that will fall between the values of LIFO and FIFO. During periods of deflation or declining prices, LIFO produces the highest income before taxes. It produces a higher income before taxes than does FIFO. You can see this on the table on page 385 in your textbook, or if you look at the comparison chart of the different costing methods that you created during the short exercises at the end of Chapter 8. Again, let's look at some of the financial statement effects of using the different costing methods. In general, LIFO best follows the matching rule and is best for income statement purposes. We say that it is best for income statement purposes or best follows the matching rule because you're costing your cost of goods sold at the most current values. It is considered more conservative for profit and lower taxable income. It is not, however, the best measure of a value of inventory for balance sheet purposes. In general, FIFO provides a more up-to-date ending inventory value for the balance sheet. This is because the inventory tends to lose value over time, and using the current costs or higher costs to value your ending inventory gives a more realistic view of your current assets for your business. So therefore, the FIFO method is better for balance sheet purposes because inventory is closest to the current values. It does not, however, provide a good method for matching current costs and revenues for income statement purposes. Again, LIFO would be better for that. So as you can see, based on the previous few slides that we've discussed, the inventory method chosen is going to impact both the financial statement and have financial statements and have both balance sheet and income tax effects. But businesses must choose one inventory method and apply it consistently. If they decide they're going to change their inventory method, they must have a good reason, and it must be noted in their financial statements. In addition, the IRS has a rule that if LIFO is used for tax purposes, it must also be used for financial statement reporting purposes because it produces the lowest income before taxes. And it produces the lowest income before taxes because the cost of goods sold during periods of inflation is going to be the highest. Using the FIFO and average cost methods in periods of rising prices may cause a business to report more than their true profit and make them pay more in income taxes. Generally speaking, a business wants to avoid paying income taxes. Therefore, businesses have to choose very carefully what inventory method they're going to choose. Let's look at the income tax effects of our costing decisions. Businesses that use LIFO over a period of rising prices may find that for balance sheet purposes, the inventory is valued at a cost that may be far below what it currently pays for the same items. Management must monitor this situation carefully because if it lets the inventory quantity at year-end fall below the beginning level for that year, the company will have to pay higher income taxes. The high income taxes would result because the company would expense historical costs of inventory, which are below current costs, and when this occurs, it is called a Lifo liquidation, because sales have reduced inventories below the levels established in prior years. This may be prevented by making enough purchases during the year and close to year-end to restore desired inventory levels. Clearly, this is something that management must monitor because they do not want to pay extra taxes. In analyzing the income tax effects, let's just spend a moment and reflect back on the cost of goods sold calculations for the income statement. The beginning and ending inventory are an integral part of the calculation of the cost of goods sold and therefore have a great impact on income before taxes for any merchandising business. As we can see here in this equation or reflection of the income statement, net sales minus your cost of goods sold is going to give you your gross profit. You take the operating expenses away from your gross profit, and that will give you your income before taxes. Your taxes will be based on that income before taxes. As you can see, your cost of goods sold, which is broken out and highlighted in yellow, your cost of goods sold begins with the beginning inventory. You add any net purchases to give you your goods available for sale or COGAS, and you subtract or take away the level of the ending inventory to give you your cost of goods sold. Again, let's analyze some income tax effects. If the ending inventory is understated, a business's income will be understated. That is because the cost of goods sold will be overstated. If ending inventory is overstated, income will be overstated. Therefore, that is because cost of goods sold will be understated. The choice of inventory method will affect not only the profitability of the company, but also its liquidity and cash flow. LIFO produces lower income taxes and therefore increases cash flow. FIFO produces higher inventory values, which will show a better short-term liquidity or current ratio, meaning current assets divided by current liabilities. Think back to those ratios from chapters 5 and 15 for your current assets and your current ratio and your return on assets. The effects of misstatements in inventory will affect a business's gross margin, its income before taxes, its inventory levels, and obviously its stockholders' equity. As we can see in this chart, it is going to summarize the effects of misstatements in inventory. Ending inventory being overstated versus beginning inventory being overstated in year 1 and year 2. In year one, ending inventory overstated will affect the cost of goods sold being understated and income being overstated. Ending inventory being understated will affect the cost of goods sold being overstated and income being understated. In year two, if the beginning inventory is overstated, the cost of goods sold will be overstated and income will be understated. Again, if beginning inventory is understated in year two, the cost of goods sold will be understated and income will be overstated. Let's look at the discussion question for Objective 5. If merchandise inventory is mistakenly overstated in year one, what is the effect on the net income for that year and the ending balance sheets for that year? Additionally, what is the effect of the misstatement on the next year's, year two's net income and the year two's balance sheet value? Let's look at Objective 6, applying the lower of cost or market to the inventory valuation. Cost is usually the most appropriate basis for valuation of inventory. However, in some cases, inventory may become obsolete. There may be physical deterioration in the inventory, or there might be declines in price levels, or a loss may have occurred. This loss must be recognized by writing the inventory down to the market or current replacement cost value. The lower of cost or market rule is applied when replacement cost of inventory falls below historical cost. Then the inventory is written down to the lower cost and a loss is recorded on the income statement. This is following the rule of conservatism. An inventory write-down can be done in one of two methods. Those two methods are either the item-by-item method or the major category method. In the phrase, the lower of cost or market, what is meant by the word market? In this particular phrase, the word market refers to the current replacement cost, or what is available for that inventory out there in today's market, so the current replacement cost. And that is the end of the notes for Chapter 8 on inventories. Thank you for listening.